You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means we are back once again. It is Friday. It is noon Central. It is 1 p.m. Eastern. Do you know what's going on in these wild volatility markets? Well, let's find out together, shall we? Because it is time once again for Volatility Views, the premier program for volatility traders. My name, of course, Mark Longo from the TAG, optionsinsider.com, as well as from the network upon which all of you are just sucking down all of my bandwidth these days. You know what? Don't worry about it. There's more where that came from, so have at it. Enjoy. If you like what you hear, this show, anything else we do, obviously we've been doing this for a while. January marked 17 years. Crazy to say out loud. But all the new stuff, all the new reviews, all the new ratings and stars that you folks give it on just about every platform under the sun. So your YouTubes, your Audibles, your Apple Podcasts, all that fun. All that stuff in aggregate does help new people continue to discover the world of volatility. And hey, new market, new year, people are discovering this stuff all the time. Help them find a way to vol views, leave those ratings, those stars, reviews. All that stuff does help. And of course, if you want to go above and beyond, you don't want your broadcast week to end with volatility views. And hey, who can blame you? You want to get in there for a little bit of options oddities after this show. Maybe you want to get your name in the hat to win the Pro Trading Crate. That's going to be going out soon for the January Pro members out there. And a whole bunch more Pro Q&As. I'm going to deep and devolve this week on our Pro Q&A. Where can you get all that stuff? Live streams for this, everything else we do, theoptionsinsider.com/pro. Once you're there, you get access to all that fun stuff. 300 plus episodes waiting for you there the second you hit that button. So all kinds of goodness in store for you. As we go around the horn, see what's in store for us on the show today. First, let's go out once again to the Southern volatility mecca known as Austin, where we are joined once again by the greasiest of meatballs, Mr. Mark SEBASTIAN from OptionPit.com. Mr. Meatball, welcome back to Volatility Views. How goes your Friday, sir?
It's going well. Happy Friday, Mark. Quite a day.
Yes, TGIF. Thank goodness it's Frantic Friday out there. A lot going on out there. Should be a fun show. And joining us to help break down this mad post-Fed volatility week and indeed earnings week and just about everything else that is driving vol out there right now, we are joined by a first-timer on the program and indeed on the network. He is Noel Smith, the Chief Investment Officer and Head of Options Trading at CONVEX Asset Management and TANIUS Technology. Say all that 5 times fast. Noel, welcome to Volatility Views.
Thanks for having me.
And Noel, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a bit of an overview of your background in the world of options and indeed volatility, as well as what it is you do day to day over there at CONVEX and TANIUS Technology.
Sure. So my background is in prop trading, market making, and I now run a hedge fund. So I started on the floor of the CBOE in the late 90s as a market maker. And over a period of time, I backed probably about 65 different market makers between the Board of Trade, the Merck, the obviously the SIBO, and also the NYMEX, the COMEX, all those other places. And, so we got a lot of exposure in a lot of different products. So that was the market making stuff. And then it kind of migrated from market making to running the book in the firm. And we kind of lorded over all things options and, all things markets really, because once you start getting a lot of guys in different pits, you start talking about bonds and commodities and all that other stuff at some point. And so that was the market making and prop trading. And I've been thinking about running a hedge fund for a long, long time. And for whatever reasons, I just didn't. And a few years back, decided to give it a go. So that's what I'm doing now. I am running a hedge fund and trying to take some of those ideas that come from, really Chicago prop trading and kind of bundle them into a package for investors.
And what is the crux of the hedge fund? Are you out there slinging volatility? You trading 0-day options? You trading VIX upside? What is the focus of the hedge fund?
All of those above. So the hedge fund is really different strategies. It's a multi-strat hedge fund. So what we're doing is we're taking what I think are the most portable, scalable, and repeatable processes from prop trading, and we're using those and kind of toggling between them as we see the opportunity set. So we have different strategies for different opportunity sets. So a different vol regime means we might be doing something more opportunistically than a different other vol regime. So sometimes we're trading in VIX. When things are really boring or slow, we might not do that as much. Other times we trade dispersion. Well, we have dispersion on in some degree or another all the time. We do a relative value volatility arb within the ZN notes, where we're looking at really event volatilities, and we're doing a projected forward vol on top of that. So just picture kind of like a vol surface that's on the screen, and then you kind of create your own vol surface, and how those two intermingle is where you see edge. And then we also do just vol arb. It's good old-fashioned vol arb. And to answer your question a little bit more specifically, we use vol to inform a lot of our trades, but we don't always necessarily express those in vol. Sometimes, we want to be in an instrument, but the vol looks either, rich report, depending on how we want to, be in there. And sometimes it's easier just to go out in the underlier. So it's kind of, there's a lot of varieties, what I'm really trying to say.
All right. Definitely sounds like there's a lot to unpack there. Should be a fun show. Let's get rolling, listeners, with the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review, the portion of the show we break down the week that was and indeed still is, from a vol trading and trending and analysis and unusual activity, all sorts of fun perspectives. And coming into the middle of the session here on this fine Friday, man, it has been quite the week. Of course, a Fed week, so that's obviously a big driver of all things volatility right now. Powell maybe not giving the bulls exactly what they wanted, spooking the markets earlier this week. We saw, obviously, quite a bit of red on the screens, and vol getting a bit of a lift. I won't say popping, but a bit of a lift on Wednesday. Then, of course, coming back at it, the bulls getting the bit in their teeth yesterday. Markets turning green pretty firmly yesterday. And then, of course, last night, one of the big days of the earnings cycle coming on. So a lot of the big names you folks watch, a lot of the Magnificent Seven. So, of course, Apple, Amazon, and indeed the artist formerly known as Facebook, all popping off last night after the bell. Meta and Amazon kind of knocking the covers off the ball. Apple, mixed bag, decent revenue, but obviously weakness in China plaguing them more than the other two. So Apple kind of down in the after hours. Facebook was up 50 handles at one point in the after hour. All sorts of craziness coming into today, and the markets are feeling their oats. Bulls feeling their oats yet again. S&P up nearly a full percent. Trading right around the 49.5 level right now, listeners. The Dow kind of flirting with unched up about almost 0.2% now. And the NASDAQ, as I mentioned, with those big names, the Magnificent Seven feeling their oats. NASDAQ certainly feeling its oats, up over 1.5%, about 1.6%. And then, of course, I buried the lead. Our first jobs report here. Again, that's also driving a lot of this catalyst as well. Labor market still hot. Maybe add in some fuel that Powell is not going to maybe cut as soon as folks think. But then, of course, good news is apparently good news again. Mixed in with all the other good news we were talking about, we're seeing a lot of green on the screen, including on the vol front. One of those days where markets are up and vol is up. VIX right now at about a 14 even. That puts it up on the week from our last show, about 3/4 of a point. As I mentioned earlier, it's kind of been a challenge to see a lot of upside and materialize and capture a lot of upside in VIX. We'll get to all that fun in a little bit. And of course, the vol of vol, VVIX itself at about an 84, up 4 points from where it was this time last week. Let's go around the horn. Let's start with our guest, Noel. You know, Noel, as I mentioned, this is your first appearance on the network. Also, it's still early in the year. So before we get into this week's action, really quickly, we're kind of getting everyone's thoughts on their takeaways from the year in volatility that was 2023. So when you look back at last year, what really resonates to you from a vol perspective, Noel?
So 2023 to me was a little bit of a continuation of, the prior years coming out of COVID. I didn't see other than the bank stuff, there wasn't a whole lot to be afraid of. I guess I disagree with the idea that it was a crazy year in vol. I thought things were relatively reasonable, especially considering where we came from. And I thought it was basically chop aside a good reason from a vol perspective to have risk on. That's my synopsis of it.
A year where not much was scary. Interesting. So let's get into this week. Obviously, a lot on the docket this week. No, I just kind of laid out a bunch of it, but there's even more I didn't have a chance to get to. What is catching your eye and lighting up your tape this week from a vol perspective?
Sure. So we got lucky in the sense that there's something to talk about that's more interesting probably than average for our first conversation here. When nothing really happened prior to Powell, right? So as he put out the published statement, the marketplace took that as something bullish, and if you look at the Fed Fund futures, the ZQ futures, we kind of rallied into after the statement and before the presser. And then as the press pool started to discuss, future topics with Powell, obviously he talked the market down, and the idea of a March rate cut kind of went out the window. He said it wasn't the base case, and the market said, "Oh, shoot, that's something we have to reconsider now." And we kind of pushed that 6 weeks forward at least, and that whole structure changed a lot. So we went from a 70% chance of a rate cut in March to sub 20 now, which is a pretty big shift. And then, here's the thing I thought was a little bit interesting. And this is a little bit tinfoil hatty, but, I don't know if what Powell does or doesn't have in terms of advanced information, but the idea that Powell doesn't want to have egg on his face does make sense to me. So if he were to have come out and been really dovish, I would think that the idea that the jobs number was going to be really weak would be on the table. And then the converse of that the jobs number would be really strong, he might be hawkish. So that was an opportunity, I think. There's something to at least kind of read the tea leaves in there. And then if you look at what happened after the market went down, vol was not really that responsive. Vol didn't go that crazy. The market didn't really go on red alert. And I didn't really see a huge reason to de-risk or get afraid. So what I actually did was I added some risk at that point. Was that lucky? Yeah, totally. But it worked out. And here we are now with, basically the earnings that came out in tech, and everything is kind of rebounded and re-ripping. So it's been an interesting week.
Obviously, this is the narrative we've been talking about on this show for quite some time, this responsiveness or perhaps lack thereof on the vol, particularly to the upside to some of these type of events. Did that come as a surprise to you at all, or is that kind of what you were expecting when you saw the markets once again having a bit of a whimper on the vol side post-Powell?
I guess I think about volatility as, kind of a threshold. So think about when you go to flush a toilet, right? So you push the handle, it requires some amount of torque to do anything. And then once you get through that threshold of torque, then, the toilet will flush. And I think of volatility as being similar to that. If you don't apply enough force or enough inertia to get things to move, they just don't. And if you're looking at the VIX complex or, any of its analogs, I guess I just wasn't that worried, which is one of the reasons I added. It ended up being the bottom, but that's very cherry picky. I ended up adding risk at the end of the day, which is an artifact of the bottom. And the reason is because I just didn't see the reaction function as being something where everybody was really running for the hills.
You definitely get the pride of place, Noel, being our first guest in the long storied history of this program, over a decade, to compare the volatility market to flushing a toilet. That's a new one. I definitely like that. Maybe I have a new title for the show out there. I like it. All right, Mr. Meatball, same question for you. What's catching your eye out there in this post-Fed, post-earnings, post-everything, post-jobs week? A lot being stirred into the stew. And do you also think the vol market this week was like flushing a toilet, sir?
It's definitely been interesting where, the sell-offs, they're not raising vol. And here we are, we're up 1% and they are buying, and they're buying options. We're starting to see skews start to flip a little bit where we're seeing some upside call chasing. I don't know if I sent this to you on for options oddities, but I think a example of kind of what kind of frothiness we're starting to see in the market overall is a trader bought the April 480 calls almost 11,000 times in Microsoft yesterday. So we're starting to see some of that upside skew start to get bid, and which tells me a couple things. One, we're getting one frothy. Two, traders are selling stock and buying calls, and three, there's not a lot of demand on the downside hedge side. As Noel said, this is a everything's okay kind of market. So it's a little weird to look at the VIX still hanging around 14. We're at all-time highs, and the VIX is $2 above the recent lows. So, there's a hint of, how much further can they stretch this market, I think, in this market. But for the week, the Powell reaction was bought the very next day, and we've gotten some follow through. So they sold the market off 80 points on Wednesday, and over the course of the last 2 days, we've rallied 110. So the market is extremely strong, very difficult, but very narrow. The rally has been almost exclusively in mega cap names. MGK, which is a mega cap ETF, is by far is even stronger than the NASDAQ 100. And the NASDAQ, which is very mega cap heavy, is stronger than the S&P, which is stronger than Dow. And here we are, the NASDAQ's up 1.7%, and the Russell 2000, it's down 0.8% on the day. The mid caps, they're down 0.25%. So the rally has been very narrow, tight, and not really participated in by a lot of the market, which I think is really interesting. Part of the reason why I wanted to have Noel on, because his background in running one of their strategies is dispersion trading. I'm looking at a market that is extremely dispersed right now.
Yes, it's interesting you bring that up because it's an auspicious day to be reminded of that. Today is, of course, February 2nd as we're recording this, listeners. It was exactly this day a year ago where we kind of saw that stratification really kick into high gear in the markets. Listen to shows like the option block where we get into the odd block, or of course options oddities, or any of these other shows where we talk about names and look back at their trajectory over the course of the past year. And there have been quite a few names outside of the big ones, right? Outside the Magnificent Seven names that we talk about a lot, the big tech names. Go back and listen to a lot of those shows. How many of those names did we talk about in options oddities or the odd block or other segments that hit their apex on February 2nd of last year? This is when the first big run-up we saw last year. Then things started to cool for a lot of names, and that was their apex really for the year. They sold off for the rest of the year. Maybe they had a little bit of a pop around Halloween or something around the Fed decision. Outside of that, there are a ton of names, as Mark just pointed out, small caps taking a hit again today. There are a lot of names outside the Magnificent Seven that hit their high this time exactly a year ago and have never looked back in terms of heading back to the downside. So this has been a very stratified market out there. And today, ironically, is the day that marks that inflection point for a lot of those smaller names out there. Speaking of inflection points, let's keep rolling out there to the land of the vol surface. That's an inflection point for a lot of your vol trading out there these days, listeners. And coming into the start of the show, we had things, as you mentioned, kind of looking a little bit firmer out there, which, again, we're kind of moving all over the place out there today. People always think upside, not vol, downside equals vol in the equities, but movement is moving at the end of the day. It all bakes into vol at the end of the day. So we're seeing, perhaps not surprisingly, that front portion of the curve, at least when we kicked off the show, looking a little bit frothier than it was this time last week. The Fed future up about 0.5 point. The March future up almost about the same level, about 0.45 as well. So looking frothy, looking a little bit stronger and firmer than it was this time last week. Also, something we've been pointing out for a while, that distance between the front future and the cash, which in the past has been a chasm. How many times have we talked about 1.5 or more between those? Much less than that right now. You're looking at about a little over 0.6 between the cash and that front future. So a very different beast than we're seeing out there right now. Mark, you've described this term structure in the past quite a bit as tight, especially when you're looking at the cash versus that front future. What's catching your eye out there in the vol surface this week?
Yeah, I mean, the story remains the same. We still have two weeks for this thing to expire, and the futures are up today too, about a 0.6%. They're pricing this thing on today like it's next Friday. Really, I'm not sure why. VIX is pricing itself like it should be at 13, or we're going to get a major flip in the curve. The way I view things. Either the floor has to fall out of volatility and normalize this curve, or we're going to get a flip.
And Noel, same question for you. First off, you mentioned you employ a lot of different strategies out there, so I'd imagine the vol surface is a big part of those strategies. But break it down for our listener. What is your use case, and how do you folks utilize the vol surface over there on your funds? And then B, what is catching your eye out there on the vol surface this week?
Sure. Everything that Mark just said, I agree with in terms of, index up, vol up, and, those things that are happening in the marketplace. Those are just, facts. So in terms of vol, why do we use it? To answer your question, a lot of the most leverage and the most informed paper is really going to come from the options market. So, if you're trying to get information for any decision that you're making, what you want to inform your decision is going to be the fastest, most contemporaneous, and most quality information that you can find. And that's why we focus on the options market. Not that there's anything wrong with fundamental analysis. It's just that it's not as fast, or in my mind at least, as actionable as the options market. Somebody comes in to buy, a million biotech calls, probably going to go up. I don't know. Not a bet I would want to bet against anyway. So we use the vol surface as a way to give us kind of like, like a weather person would look at the weather. You have all of these factors that are going into making a decision if you want to go out and bring an umbrella or not. And the volatility surface will a lot of times do that. And there's not just one vol surface. We mainly speak about index, but there's volatility surfaces really in everything where there's derivatives. And a lot of times the bond market will presage the equity market even faster. So if you're looking at things like the ZN futures or the ZN future options, you can see a lot of volatility in there and how it's going to bleed into what else is going on in the marketplace. So that's something else that we use because, the price of money undergirds the price of really everything. And then when it comes to interest rate and interest rate volatilities, that also informs our dispersion trade. So we're able to get a lot of actionable ideas from the volatility surface. Or the other side of that is, when do we exit those ideas, or when does our trade thesis break apart?
A lot to unpack there. By the way, Noel, our live listeners in the live chat, they're all very much enjoying your volatility flushing the toilet analogy here. So you're making some fans of our live listeners on your first appearance there, Noel. So there you go. No accounting for taste, but they're enjoying it out there. As we keep on rolling here into the land of the vol options. Really quickly before I get into VIX options, Noel, I'm curious. You kind of mentioned 0 day a little bit earlier in your conversation. That is kind of the option story that is inescapable right now. For a lot of people, that is the lens at which they view the volatility market now. They're solely focused on a 1 day frame of reference for volatility, which for people like you and me who've been around the vol space for a while, that sounds like nonsense. But for these people, they're not thinking it as gamma. They think of it as vol. You mentioned you utilize all of the above. So what is your use case? What is your viewpoint even on the 0 day options scene? I know it's still quite controversial. Where do you fall? Are you a fan? Are you not a fan? And what is your use case for them over there?
I guess I'm dispassionate. I don't really think of them as being, a weapon of death or a, road to mega riches. I think that if you have any one plan in this business, eventually it's going to go out of business, right? If you're always a put seller or always a put buyer, neither one of those two things are going to work forever. So I don't look at a 0 day expiration option any more risky than I would any other expiration that have been around since I started trading. I do think that there has been a lot of press attached to the idea of, selling specifically options. And I think that, for individuals, or small groups that might be out there, naked selling options if they can get the margin away with it, they will blow out. But do I think that, Susquehanna, Citadel, and Goldman are all doing the same thing unhedged? I do not think that. And I do not think that it's at this point at least, a systemic problem. I guess the biggest pushback on that would be, you could say that there's not intraday margining. Well, there is and there isn't. There's ways to get around that. If you trade away and you can try to hide those things from your prime, you might get away with that for a day or two, but you're not going to get away with that in good faith for any period of time. So those are not strategies that are sustainable that anybody can really gain for all that much. So I guess I don't think that zero DTE are a weapon of mass destruction in their current iteration. And I think there's good opportunity there for people to either transmute the risk that they otherwise don't want to put on their book or collect some edge where they otherwise wouldn't be able to. So I think of them as being a net positive right now.
Noel, I'm not sure if you're aware, but you're not allowed to have a nuanced middle of the road opinion on zero day. You have to be either all in or they are the devil. There is no middle ground, sir. We'll let you mull it over a little bit. We'll come back to it at the end of the show with a much more histrionic perspective. As we keep on rolling out there into the land of VIX options, are VIX options looking crazy today? The answer is not really. It's been kind of as you might imagine, a very topsy-turvy week out there. Today, right now, only 336,000 contracts on the tape. The ADV, though, looking a little bit firmer than last week, up to 681,000, up about 47,000 from this time last week. So kind of back and forth on the ADV front right now is the vol space trying to find its footing. Before we get out to this week, let's get out to the top 10 size positions. What's open for size out there in VIX options right now? Let's find out together. If you're waiting, if this is the week, you're thinking this is the week, the toilet flushing week where everyone's going to be buying the puts, the answer is no. Once again, all 10 of the top 10, all calls, all the time has been that way for months now, listeners, showing no signs of changing anytime soon. Cost you $188,000 to break into the top 10 in VIX land. I get you all the way out to the April 60s. So we're starting out hot. We're starting out, shall we say, far out of the money. Optimistic. Call it what you will. Maybe pessimistic if you're looking at 60 strike. Either way, we're starting out at the April 60s, 188,000 of those. Number 9, back to somewhat more reasonable. April 20s, 208,000 of those. Number 8, 212,000 of the March 47.5. So right back at it, listeners. Number 7, 213,000 of the May 47.5. So keeping the upside party alive. Number 6, 214,000 of the Feb 16s. What's that doing in there? That's far too reasonable. Number 5, 221,000 of the Feb 30s. Here we go. That's more of what we expect. Number 4, 225,000 of the Feb 18s. Number 3, 261,000 of the March 20s. Number 2, 360,000 of the Feb 20s. And the number 1 size position, if you've been listening to the show for a few weeks, you could probably guess what it is. Yes, it's our old friend, the Feb 17s, the largest single block prints in VIX options history, still open for size, continuing to pile in on that strike. Nearly 400,000 open out there this week, 398,000 to be precise. So it's been an interesting trade. Everyone watches this trade day in, day out to see how it's performing. They opened it back on the 12th, as you'll recall, listeners. And spoiler alert, it's not looking great. We were just talking at the top of the show about how challenging it is to monetize VIX upside right now. Obviously, they have size other positions against this. This is probably just a hedge, but just through the lens of this trade alone, which is all we can really watch, this side of it ain't looking great, listeners. It had a brief moment in the sun. About 5 days later on the 17th, these options closed over $1. Remember, they bought them for about 67 cents, listeners. So they had a brief moment, and then that was really about it. Yesterday, they closed at right around 50 cents. Trading as low as around 41 cents this morning. Probably have ticked up a little bit since then. So far, this one not looking great. So if you're out there tracking the saga of the Feb 17s, obviously you still have some time left. The history is not yet written on this trade, but so far, they're not looking great. Again, that's just on the side we can see. There's obviously other sides of this trade we cannot. Let's keep on rolling out to the action today. Like we said, today, not exactly lighting the world on fire. 336,000 contracts on the tape. The big, most active contract today, about 50,000 of the Feb 14 puts. So again, puts are trading out there fast and furious. Just not enough to accrete into our top 10 each week. Number 2, 46,000 of the Feb 13 puts. So here we go, more puts. Number 3, 22,000 of the March 14 puts. So a little bit of a put palooza this morning. Number 4, 20,000 of the Feb 30s. And number 5, about almost 13,000 of the Feb 18s. Getting out to Thursday, about 500,000 contracts on the tape. The big dog on Thursday, 31,000 of the Feb 13 puts. So again, more puts lighting it up. Number 2, 29,000 of the Feb 13 halves. Number 3, 20,000 of the June 20s. Getting out to June, number 4, 20,000 as well, the Feb 14 puts. And rounding out the top 5 on a somewhat light Thursday, especially on a Fed week and an earnings week, 20,000 of the April 23s. Wednesday, Fed day. Even then, not quite the day we've come to expect on recent Fed days. We're used to Fed days putting up 1.1, 1.2, even more contracts like it's nothing, like snapping the fingers. Wednesday, 731,000. So kind of almost half of the kind of volume we might expect on a decent Fed day. The big dog on Fed day, 81,000 of the Feb 13 half puts, followed by 50,000 for number 2 of the April 50s, 5-0s. 35,000 for number 3 of the Feb 20s. Number 4, 35,000 as well of the May 65s. So forget the 47 halves, any of that kind of fun. Let's go to the May 65s, and then rounding out the top 5 on Fed day, 27,000 of the Feb 13 puts. Tuesday leading into the Fed, a little over 500,000, about 526,000 contracts on the tape. The big dog, once again, back to the April 50s, 51,000 of those, followed by number 2, 29, almost 30,000 of the Feb 26s. Number 3, 27,000 of the March 26s. Number 4, 23,000 of the March 20s. And number 5, 20K of the March 18s. And then Monday, again, kind of an anemic Fed week, listeners. We're used to seeing a lot more paper, just not a banger week. 355,000 contracts on the tape for Monday. The big dog looks like 21,000 each of the May 18 calls and the May 18 puts. So maybe a bit of some straddle action going on there. Followed by number 2, 20,000 of the Feb 13 puts. Number 4, 18,000 of the Feb 20s. And number 5, 15,000 exactly of the October 17 puts. That's an interesting one. Opening 15,000 of those. 17 puts in October. That's kind of intriguing. I might have to dig into that one a little more. Mr. Meatball, like I mentioned, not exactly a rock'em sock'em robots week, especially given the fact that we had the Fed week this week. We had the jobs number this morning. We had massive earnings all throughout the week. You might be forgiven for expecting a little bit more paper this week. Anything catching your eye out there in VIX options land this week, Mr. Meatball?
You know, I think everyone was kind of positioned ahead of this week. That I think that's maybe why the volume is a little light. We're buttressed against a couple of weeks where volume was very heavy. So I'm not a little bit surprised. I'm not really surprised that volume was a little lighter this week. I think we'll end up having a busier week next week for sure. But really not a shocker that traders position themselves ahead of time. I know it sounds crazy talk, but that's the way that they do. Here's a trade I do kind of like, Mark, that just went up. A trader bought the 14-13 put 1x2 for February. They bought the 14 puts 20,000 times for 48 cents, and they sold the Feb 13 puts 40,000 times at 11 cents. So they picked up the 1 point put 1x2, and they paid a debit of 26 cents. I like the setup. I'm not sure about the pricing, but I like the setup.
Yeah, they're shelling out a little bit for it. I'm looking at it right now as well. You're right. They paid 26 cents for it. I don't love the outlay, but yeah, the intention behind it, we always talk the other way, right? We always talk sell 1, buy 2 to the upside. And sometimes we talk about that to the downside, but it isn't as prevalent of a trade out here. But going the other way, buying 1, selling 2, certainly interesting, especially in this environment where VIX and Vol seem like it's having a hard time really getting much beyond the 13 handle to the downside. So kind of intriguing. Noel, same question for you. I don't know how big of a part VIX options play over there in your funds, but this was obviously a Fed week. You might be forgiven for expecting a little bit more paper going up out there this week. Anything catching your eye in the world of the volatility options this week? No.
Yeah, so I figure a lot of the paper isn't there because half the industry is in Miami for various conferences. So, a lot of people that are actually the decision makers aren't really on the desk. And Mark Sebastian's not going to believe me to steal his idea, but I think the March 1x2 is a really good trade as well. I was already looking at that, so I'm not stealing your idea. The March 15, 14 1x2 went up for basically zero. And so you're saying that you buy 1 15 put and you sell 2 14 puts for basically nothing. And I think it's a good little trade. You get a little fade. It doesn't cost you anything other than some commissions. And I think that's a spot on trade. I really like that trade. And it's very similar to what Mark Sebastian just mentioned.
Mark beat you to the punch on that one. That might be a good one to put out to our audience to compare and contrast. Which 1x2 do you like better on the put side? Shelling out a little bit for a little bit more at the money / out of the money Feb, or going a little bit beefier, but for zero outlay in March? Yeah, that might be an intriguing one for our listeners. Interesting stuff. So yeah, a lot to unpack out here in this Fed week. You know, before we get into some of the vol ETPs, Noel, you've talked a lot about dispersion. I think we have a listener question about it a little bit later as well. So maybe it's going to be a dispersion heavy show, but this is obviously earnings week. A lot of individual equity vol going up this week versus what we're seeing in the index. So this, I think for a lot of people is a very active week. How big of a driver is earnings season for your dispersion trading, and what kind of setups and names are you keeping an eye on this week?
So earnings season isn't, it happens every quarter, so it's not really a driver. We're completely aware of it. We feel like on balance, it has a muting effect. And if you think about dispersion, for people who don't really trade it, it's basically, do you want to be a stock picker or not a stock picker? So if you think the market is going to move as a unit, you don't want to trade dispersion. If you think that the market is going to do its own thing and, Meta is going to go up and, ExxonMobil is going to go down, well, then that is a good dispersion trade. So, we look at I'm using the same word twice, but it means different things. I'm using the dispersion of ideas to inform the dispersion trade. In other words, if you look at where Fed fund futures are going to be priced in the future versus the estimates of that, if you have a large scatter plot of ideas, and this also maps to earnings. So say, for instance, you have, Apple earnings. And, some analyst thinks it's going to be super duper high. Some other different analyst thinks it's going to be super duper low. And there's a really wide breadth of opinions. Well, that means there's more possible outcomes. Versus if you have everybody says exactly the same thing, then that is a much tighter scatter plot of ideas. And that type of information informs the trade. So we look at that. And in terms of the individual names, what we do is, and this is kind of what we do in-house, is we screen for where we think that there is opportunity in vol to buy. We buy volatility in single names, and then we sell index volatility against it. And the idea is that, the single names that we're buying volatility is, will go crazy, and the index will do nothing, and then we're able to profit, on 3 different categories.
So what you're saying is earnings season to you is kind of like St. Patrick's Day at the bar. It's amateur hour. You don't like to play there. You like to play in the more unsullied waters in between, no?
No, I'm saying the opposite. I think that earnings are often quite good for dispersion.
Really? What do you? All right. So hey, we're not going to let that one off. Let's expand on that, please, Noel.
Well, let's look at this week. We don't have to even go that far back. On earlier in the week, you had a bunch of tech that all did poorly. Then later in the week, you had a bunch of tech that all did really well. So, but what is the net of that? Well, we're up a little bit, right? It's not that big of a deal. So if you take a look at the marketplace writ large, and then you are able to handicap for sectors, in addition to the things that are hot right now, which is really just a handful of stocks. But if you look at that in terms of like utilities, oil, interest rate sensitive things like real estate or whatever else, it really does map out to a lot of different ideas. But if you net them and then you look at where is index vol price relative to these individual components, and then you boil it down even more granularly from the sector to the individual names, there's a lot of opportunity there because, one name might go crazy like Meta, which is great because if you're long volatility in Meta, I assume you didn't have that, that straddle on price the way it was because I don't think too many people did. That's a great trade. And then if you did the other way around, if you you thought that there was another name that wasn't going to do anything or that was going to maybe sit around, that's another opportunity where it doesn't really matter to you if it goes up or down a lot. But the net trade, which is going to be expressed in the index, can also be profitable. So in my experience, earnings seasons in general are good for a correlation dispersion book.
That's interesting. Noel, what did you think? It was interesting that, the only stocks that out of the 5 biggies that it reported this week, only Facebook had a straddle price that was bid above kind of the long-term mean of those percentage moves. And here we are, and it's up $1 billion. But I appreciate that sentiment. Yeah, I think earnings. I don't generally trade a lot of earnings themselves, but when you do get vols that are misallocated, it does present some different opportunities in these mega cap names. If you went long straddles on all of them and decided to let's say short the index against them, you probably did pretty well.
Since we're talking,
It depends.
Well, go ahead, Noel, if you have a response to that.
I was just saying it depends. Part of our alpha is really also in the sector weighting. So while there's only 7 names that we all talk about these days, there are other names in the S&P 500. And the apportionment and the weighting that we can give those based on the relative cheapness or richness of the volatility, it really gooses the book quite a bit.
Since we're going deep into dispersion, I'm going to cheat. I'm going to bump up this question from our Vol voicemail segment because we're already coming up against it. And we're already talking about dispersion. And this person sent this in weeks, if not over a month ago, and they've been waiting patiently for their answer. So let's get out into this one now because it dovetails nicely with what we're talking about. This comes from Max Attack. I like the handle. You get points for the handle there. He says, hey, Hey, Volmongers. I like that. I don't think we've been called the Volmongers before. He says, I saw this release from the SEBO and figured you guys were the ones to explain it to me. What the heck is this thing, and does it even matter? And this goes back a few months now, listeners, when SEBO announced they were launching a new index, the DSPX index, which, of course, is exactly what we're talking about now, measures expected dispersion in the S&P 500. This release he sent actually goes back to September 27th. So this has been percolating for a while. Obviously, we haven't really had a chance to dive deeply into it here, but this is going to be the launch of a new index, the SEBO S&P 500 Dispersion Index. What makes it interesting, obviously the SEBO has launched a lot of products in the vol space over the years. Most of them don't translate into a tradable product. The intriguing thing about this is it does look like the plans are for this to eventually become a tradable product out there. So that's very interesting. Again, I encourage you, if you're intrigued by this, you somehow missed the release, go check it out over there on the SEBO website. But Noel, as a guy who's slinging vol and indeed trading dispersion day to day out there, for our listener here, Max Attack, who's a little bit confused, if you want to explain what the SEBO is up to here, and then B, as a guy who's already trading dispersion, does this interest you, or is this something you'd rather roll your own than use the SEBO index?
I think that the SEBO launched this as a precursor for a tradable product, dispersion futures, which I think will be in the 30-day tenor. So I think that insofar as like VIX is useful, well, back when there was no VIX futures, it was one of those things that we would all just look at and contemplate our books. But when it became more tradable, it fed into a reflexive loop that was a little bit more actionable. So now the VIX, I still don't actually look at the VIX that much. I look at the VIX futures with the tradable products. I don't have a position in the actual VIX, of course. So to me, I just think about, what is it that's in my book or can be in my book. And DSPX in its current iteration is not super useful. You can think about times like, when the index went nuts, but how did the index go nuts? Like, during Volmageddon or in COVID, there's a lot of correlation in COVID. The market overall went down and everything happened. But in Volmageddon, it was, just really 2 ETFs that, got over their skis and blew out. And so those are mirror images of each other in terms of the DSPX. One was a systemic problem. The other was not a systemic problem. So what the DSPX would show in those 2 instances are basically, how do you figure out if this is going to be something that you should or shouldn't be worried about? And those are the 2 main times I think that this product is useful. But it's really looking at where do you think things are going to be in the future in terms of, a dispersion of names. I've used this analogy before. Think about if you're holding like a handful of marbles at shoulder height and you drop them on a marble floor, they'll scatter everywhere. Or if you hold them and drop them onto a pile of mud, they'll go nowhere. So going nowhere is extremely low dispersion. Going everywhere is very high dispersion. And that trade is informed by a lot of things. But that's where this thing is really meant to kind of give you a bird's eye view of where does the marketplace think that dispersion is going to go. And you'll see that mainly it just kind of hangs out in the 20s. It's really not that crazy of a product.
Mark, same question for you, sir. You were down at RMC when SEBO kind of announced this thing. What are your thoughts for our listeners on this this forthcoming dispersion index and the potential for some tradable products around it, sir?
Well, RMC is the gift that keeps on giving because that's where we found Noel too. So,
well, the jury's still out on that guy. We'll see. But dispersion,
great event. Yeah, I Noel did a talk on dispersion that was informative and insightful, and I based on what I've heard, there is a use case. I think people will want to trade it. I don't know that. I don't think it's going to be a blockbuster like VIX futures, but I don't think it's going to be a bust like the NASDAQ VIX futures were.
Yeah, great question. By the way, if you're intrigued by trading all this individual vol against, of course, the index, we have been telling you folks for a while and crunching all the data for you folks because we like you over there at theoptionsinsider.com, especially for this time of year. Earnings season, all the individual vol levels are going on out there. We did make a point yesterday on the option block when we were crunching the numbers ahead of Apple, Amazon, and Meta coming out. You know, Apple was pretty much in line with their previous movement, a little bit of extra juice. Amazon was about almost $1 less, so that looked pretty cheap in hindsight. The one we did point out, though, yesterday on the show was Meta. They were not quite half of their previous movement they were pricing in, but they were pricing in quite a bit less in terms of vol than what they had in the past. So that one kind of leapt off the page to us as maybe a screaming premium buy opportunity. Of course, in hindsight, it looks even better, obviously, with Meta up a whopping 83.5 handles or 21%. I mean, these numbers are starting to just get off the hook. If you thought they were crazy last year, here we go. Meta moving 21% in one day. I mean, these are the kind of things people would joke about not too long ago. Yet these are the realities of the market we're all in right now. Speaking of the realities of the show, listeners, we're starting to come up against it. Let's run through some of these vol ETPs really quickly, then we'll get to the crystal ball for this week. Kicking it off out there on the inverse front, our old friend SVIX, obviously taking a little bit of a breather this week, 38.70 right now, down a little over a point, about 1.3 points from last week. So a rare week where it's not setting new all-time highs just about every day. Volume-wise, kind of like 2,100 and not a lot going on out there. So we'll roll past good old SVIX out to its sibling product, UVIX, which is another one having a rare moment of upside, up a full point, 1240 right about now. So that's a decent move for the week out there. You know, it takes a lot to really lift UVIX and keep it up. So up a point right now on the week. UVIX at about 10,000 contracts right now, which is also looking pretty good, given the fact that the ADV is about 13,000. That's popped about 2,000 since last week. Most of that on the back of that monster trade we talked about on the show last week. 20,000 of the April 12s going up in UVIX. Paper buying them for, I believe the price was around 270. So this was no small outlay here. Obviously, so far they're looking pretty good. The question with this is going to be like anything else. You know, when do you start getting out of this thing? Obviously, they're putting this on for 270. They're looking for more of a significant move to the upside than just this. But still, at least so far in the first week, they're looking okay out there. And let's go out to our buddy Mr. VIXologist's favorite product on the planet, UVXY, at an 8 even right about now, up about half a point. Also doing decent paper today, 78,000. The ADV is about 108,000. That's kind of treading water from this time last week. Noel, when you're not busy slinging VIX and looking at the term structure and trading some dispersion, what role really do these vol ETPs play in your analysis? And are you out there slinging any of them day to day at your funds?
All the time. So it depends on, where the vol regime is. But I don't really care if it's, VXX or if it's going to be VIX options. Depends on where the paper is. VXX, a lot of these products, they're a bit thin to do anything for real in. So even though I don't have any problem with the products, if there's not real paper in there, I can't go out there and be the long ranger and, buy a bunch of, options or sell a bunch of options when I'm the only guy out there. It's too prohibitively expensive. But yeah, I've been using these things, even XIV and SVXY, I used back in the day before they went to heaven.
So no, you don't want to be.
Did they go to heaven, or where? Or did they go to?
I don't know if they went to heaven.
That's nice of you. That's
poor choice.
A very. I love the way that you. I love that positive attitude about where XIV ended up.
That could be a Disney movie. All vol ETPs go to heaven. There we go. I like that. I don't know if XIV landed there, but that's a conversation for another day. Mr. Meatball, same question for you. What's catching your eye out there this week in SVIX and UVIX and UVXY and all the other funds, sir?
Yeah, I mean, they've been SVIX is down a little bit. The vol ETPs are rallying a little bit with the VIX futures. VIX futures are up on the week. There is a, like I said, we're having a blow off the top. This call chase, it's driving vol higher, and until the market takes a breather, these are going to be a tough short.
Well, also bear in mind that Powell is talking at 60 Minutes on Sunday. So, that's something that, might go into some people's calculus into this stuff. And also, if you think about, because everyone's saying this might be a blow off top, a lot of people might be replacing some of their your index with options, which makes sense, right? Yeah. You might want to, it's kind of like rent the top as opposed to buy the top.
There you go. A little stock substitution. Hard to argue against that right now. And it's hard to argue as well that we're coming up to the end of the show. So it is time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, welcome to the crystal ball, the portion of the show where things get dangerous, things get difficult. And if you ever needed a better example of just how capricious the vol markets can be, man, I was looking good right before showtime. I was pretty much exactly at the bullseye of about 13 3/4. Then, of course, as the show has gone on, vol has drifted a little bit to the upside. We're at about a 14 handle right now in VIX cash. All that a long way around to saying, man, I was close. Man, I was close. I was right at 13 3/4 right before we kicked off the show. But that's what vol is. It's a fickle mistress. It giveth and it taketh away, listeners. And so my 13 3/4 is still looking pretty good in the horseshoes and hand grenades, but not within our margin of victory, unfortunately, for this week. Unless I can talk for a bit and delay things, and we'll see. Maybe VIX will come back to me. But for now, that's an old trick. See if I can play that one again. But right now, listeners, 13 3/4, VIX are at about a 14 handle. The Greasiest and Meatballs doing his palindromic nonsense. I've said it before, this does limit him. So if he gets a bullseye, it's going to be even doubly crazy. He was at a 14.41, playing out his palindromic game. No joy for him. Then our buddy, Mr. Scott Nations, on the show last week, he didn't guess VIX. He guessed his volley, which he was at 11.5. You know what? Nations Voldex, 11.5 exactly right now. So my goodness. You know what, Scott? I guess it goes to show he knows his own product. So Scott gets the bullseye for this week. I'll have to look and see how much volley was moving today. It's had a range of about 0.19, so it's not like it's doing nothing. So I don't know. There you go. Scott getting an exact bullseye. I'll have to reach out to him and tell him that. He'll be excited. All that a long way around, Noel, to saying our guest last week got a bullseye. So that puts you, sir, in the unenviable position of going first. What are you feeling for VIX at this time at the end of the show next week, sir?
So I like the March 1x2 that we talked about. So that puts, VIX in something like a 13 handle. I would take the under on that, maybe ever so slightly, something in the 1290 range. There's not that much at macroeconomic data. Vol is going to get some clarity based on Powell's 60 Minutes interview in addition to what he just did past week. And there's just not a whole lot of catalysts, from this conversation till next week. So I think vol goes in. That's why I like that 1x2. I think we get something with a very high 12 handle.
I don't hate your reasoning. I certainly wouldn't hate it if things worked out that way. I was the next closest, so I guess I will go next. And I was at about a 13 3/4 last week. I don't hate that level. I'm going to take it in a little bit next week as well. I'm going to take it down about 0.2 to about a 13 double for this time next week. I'm still waiting, listeners. If I can keep talking, maybe vol will come back to me. So far, it hasn't happened yet, but we got a few more minutes left in the show. Let's see if the Meatball can buy me some time. Mr. Meatball, sir, what are you feeling for this time next week from a vol perspective?
Well, this little VIX up, SPX up always makes me a little nervous. So I would not be surprised if we did get a little bit of a breather. I'm going to go out and say 1441.
How did I know?
No, I'm always palindromic with my guesses, just because this is such a ridiculous thing to try and guess. By the way,
it is 100% skill. Hence, you're painting yourself
like all trading.
Painting yourself into your corner with the palindromic nonsense. So that is our market for next week, listeners. A Noel on the downside at the 1290. The Meatball doing his palindromic nonsense at 1441, and the Goldilocks, aka the correct prognostication, coming in the middle at 1355. All right, everybody, that music means we have come to the end of another journey through volatility. Noel, we had a fun time having you on the show. Did you enjoy your first outing on Volatility Views, sir?
I did. It's fun talking shop. I like this stuff.
Well, Noel, before we go, if there's any other thoughts or ideas or trades or trends that you're keeping an eye on that you want to share with our listeners really quickly, now is the time, sir. The floor is yours.
You know, I'm getting like pigeonholed as the dispersion guy, but and that's definitely not our trade, but we just have, that's part of our book. But I think that it's a golden era for dispersion, and it's been that way for a few years now, and I think it's going to be good for a while. I think it's going to be a stock picker's market. I think if rates go up, which nobody thinks that, it can be good for dispersion. If rates go down, it can be good for dispersion. And I think that until rates have a new predictable steady state, whether that be a 2% inflation or whatever, there is still going to be uncertainty, and that, you know, that width, again, that scatter plot of ideas is still quite wide. And there's a lot of reasons that, you know, tech can come back and oil can go up, or real estate can go down or up, or whatever else. And there's all these reasons that things can go crazy from here. And so I still think that that's a very good trade for the foreseeable future.
And Noel, if folks want to check out what you and the team are up to over there at Convex Asset Management and TANIUS Technology, where should they go? What should they do?
I'm on Twitter, just at Noel Convex, or you can just go to the website and try to contact me that way.
There you go. Check him out. Give him a follow on Twitter at Noel Convex. He is now our go-to dispersion guy. He has been pigeonholed, so ask him all of your dispersion questions. And nothing else. Only dispersion is all he's allowed to talk about.
Perfect.
All right. And Mr. Meatball, same question for you, sir. If folks are intrigued, they want to reach out and talk some vol with you, where should they go? What should they?
Yeah, just head over to optionpit.com and come check us out. I'm writing or recording videos on what I'm seeing in the volatility and trading space every single day. Come and check us out, optionpit.com.
There you go. Check them out, optionpit.com. That is going to do it for Volatility Views. Also going to do it for the on-demand portion of our broadcast day. For those of you on the pro side, hang out. We'll be back in a little bit with Options Oddities, breaking down a wild week from an unusual activity perspective. What kind of crazy trades are lighting up our tape? Well, I guess you got to tune into Options Oddities to find out. If you want to check that out for yourselves, theoptionsinsider.com/pro is the place to go. And then for all of you, we'll see you back here on Monday for the old option block all the way through with our usual array of programming. Until next Friday, another episode of Volatility Views. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.